Order blocks are one of the most talked about concepts in smart money trading, yet most traders still struggle to use them consistently. Some order blocks react cleanly, while others get completely ignored, and that difference is not random. To understand why, I analyzed and backtested over 100 order block setups across different market conditions. The goal was to isolate which characteristics actually matter and which ones don't. What became clear is that order blocks only perform well when specific market conditions repeat. In this video, we'll start by covering the core rules used to define a valid order block and the exact execution model used during testing. Then, we'll break down the conditions that significantly improve probability and explain why certain order blocks consistently fail. An order block is defined as the final candle before strong displacement occurs, leaving inefficiency in price. This candle represents the point where large orders entered the market and forced price to move aggressively. Order blocks can form at the beginning of an impulse or during continuation. Candle color itself is not important. There are 3 rules that must be met for an order block to be considered valid. First, it must create inefficiency. Inefficiency forms when price moves rapidly, leaving weak structure or gaps between candles. Second, the move must cause a break in structure or a clear change of character. This tells us whether the market is attempting continuation or a shift in direction. Third, the order block must be untouched. Order blocks are single-use zones, and only the first return provides a valid trading opportunity. Once a valid order block is identified, entry is placed at the beginning of the zone. The stop loss is placed at the opposite end of the order block. Take profit is set at twice the stop loss distance. With this risk model, even a win rate in the mid-30% range can maintain break-even performance. The key elements to evaluate when trading order blocks can be grouped into 4 main areas: market structure, market volatility and spread, overall market trend, and the presence of fresh order blocks with lower timeframe confirmations. Starting with market structure, certain recurring patterns appear in price action on a daily basis. In the first scenario, a valid order block suggests a potential long setup. However, when analyzing the left side of price, a visible gap exists just below this initial order block, along with another valid order block positioned underneath it. This creates a strong probability that price will move lower to fill the gap, take liquidity below the first order block, and then continue higher once it reaches the second order block. When this structure appears where a gap and another valid order block sit directly beneath the first one, the first order block is downgraded by 1 point in terms of trade quality. A break below the first order block does not automatically indicate a reversal, as it often represents a liquidity sweep before continuation. In contrast, the second structure shows a valid order block where prior price action has already swept liquidity below equal lows. This liquidity removal can provide fuel for subsequent directional movement. When an order block is responsible for clearing liquidity above or below equal highs or lows, it is upgraded by 1 point for trading purposes. The third structure closely resembles the second. An order block sits ahead of price, and as price moves toward it, a support level forms where retail traders commonly place stop-loss orders below the lows. This increases the likelihood of price dipping below those equal lows to collect liquidity before continuing upward once the order block zone is reached. To illustrate this with a real example, consider on the 1-hour chart. A valid order block is present that produced both displacement and a break in structure. On the left side, a support level is visible where price was rejected multiple times, resulting in concentrated liquidity below it. Beneath this area, gaps and another valid order block are also present. This alignment increases the probability that price will break below the liquidity zone to fill the gap, then resume higher movement after tapping into the lower order block. The second factor you need to consider when trading order blocks is market volatility and spread determine whether an order block can produce a technically valid reaction. Order blocks rely on liquidity and price displacement to function, so low volatility periods generate shallow or incomplete reactions that fail to provide a clear entry. High volatility sessions enable price to test and react to order blocks effectively. Spread affects execution precision. If the spread is larger than the typical reaction range of the order block, entries can be missed or stops triggered without actual structural violation. Execution requires assessing volatility relative to the session and ensuring the spread is small enough to capture the zone's reaction. The third factor you need to consider is market trend and order block freshness determine reaction probability. Order blocks aligned with the dominant higher time frame trend are more likely to hold. Fresh order blocks retain unmitigated liquidity and provide cleaner reaction zones. Older or stale order blocks lose effectiveness as new structure and opposing pressure form. The last factor you need to consider is lower timeframe confirmation is therefore a critical factor when trading order blocks. Confirmations help filter out weak setups when price chooses to run through an order block without reacting. Also, having a solid entry reason as confirmation in our trading arsenal makes us trade more confidently. The order block approach is not restricted to a specific time frame. After identifying order blocks on a higher time frame, price is then analyzed on lower time frames to refine entries and confirm intent.
For example, when the higher time frame bias is taken from the 4-hour, 1-hour, or 15-minute charts, execution is refined on the 15-minute, 5-minute, and 1-minute charts respectively. On the 1-hour chart, price is in a clear bullish structure, forming higher highs and higher lows. A strong impulsive move breaks the previous low, leaving an inefficiency. The last bullish candle before this impulsive bearish displacement is marked as the bearish order block. This candle caused the imbalance and the change in character, and price has not yet returned to it, so the order block is fresh and unmitigated. This defines a valid higher time frame supply zone, and directional bias remains bearish. After the impulsive move, price pulls back slowly, indicating weak buying pressure. On the right side of the chart, equal lows are visible below recent price action, suggesting resting liquidity. The expectation is for price to retrace into the 1-hour order block, potentially sweeping internal liquidity before reacting higher in continuation of the trend. On the 5-minute chart, a minor sweep of equal lows occurs just before price reaches the refined order block, confirming liquidity removal into the zone. Once price taps into the refined order block, a clear change of character appears. The market stops making lower lows and breaks above the most recent lower high. After the change of character, price retraces slightly and creates a small bearish displacement, leaving a minor inefficiency. The last down candle before this displacement is marked as the 5-minute entry order block. A buy order is placed at the open of this candle, with the stop loss below the low of the order block, aligned with the invalidation of the structure shift. The first target is the internal high formed before the pullback. Partial profits can be secured there. The final target is the previous 1-hour low, aligning with higher timeframe structure. As price forms new lower high on the 5-minute chart, the stop loss is trailed below structure, allowing the trade to run as long as bearish price action remains intact. This approach is not limited to a specific pair or time frame. Results depend on proper testing, session selection, and execution discipline. Order blocks are not standalone signals. They only work when structure, liquidity, volatility, and timing align.
So that's it for this video. I hope it added value to you. If it did, please go ahead and hit the like button to show your support. And if you're new to the channel, consider subscribing. I'll see you in the next episode.